Hey everybody, Mike Molina here. Well, this morning, Friday, August 2nd, the stock market crashed. And of course, everybody overreacted and the world is ending. Not really, but I couldn't resist, and so hence the thumbnail. So I'm going to go over a few things of what happened and why it's really not all that big of a deal. It is, but it isn't. But we're going to talk about it right now. Okay, so what is driving this is the BLS jobs report. That's a measure of how many jobs were created and unemployment. So what you can see here is all the way back to February, the monthly change in employment. And right now, the unemployment rate just hit a high of 4.3%. Now, that may not sound like a lot, but in terms of the economy and how it's doing, it is. And there was an extreme reaction about it. And the issue is what's been going on is if we look here, it was expected that 175,000 jobs were going to be created, but only 114,000 jobs were reported as being created. Now, the problem is that, as has been the habit for the last little while, is whatever amount of jobs that they say they've created, it's always revised down. So if we look at the past 2 months, we can see that in May, first it started at 272,000 jobs, and then that was almost immediately revised down to 218,000, and then they revised it down to a final 216,000 jobs. And then in June, they reported, hey, 206,000 jobs were created. That was revised down to 179,000 jobs created. And it's been like that going back for the past few years. And not only that, but the thing that's been driving the job creation in our economy is that most of the jobs are, for lack of a better term, government sponsored jobs. So these are government jobs, healthcare jobs, jobs that are paid for in large part by the government. They're not private sector jobs, which is a true measure of the health of the economy. So when you have this false propping up of the economy by government funded jobs, it's not truly a measure of the health of the economy. And you can only do that so long before it comes back on you, right? So we know that this 114,000 jobs that were created, which is already $61,000 below the estimate, is going to be revised down. And so it's going to be really bad. So the market didn't like that at all. And the economy, the stock market crash. So that's when you get articles like this. Now, I just told you on Wednesday that you're going to start hearing the words recession and all sorts of terrible things coming out in the news media. And whoop, here it is. So global stock market meltdown. As fears grow, U.S. economy will collapse. So that's a very incendiary article title, right? And it makes you think that, well, the world's ending. Really, not so much. Let's take a look at the stock market and the last 4 recessions, shall we? So here we go. Now, these gray bars represent recessions, okay? Now, this goes back to 1988. There's more recessions, but this is enough of a look back. And this just measures the NASDAQ composite. But you can do this with the Dow Jones Industrial, the S&P 500. It doesn't matter what you stick here. It's all going to look the same. So the width of the gray bar indicates the length of the recession. So here we have 1991, okay? And you can see, if it's a little bit small, but right at the beginning of the recession, the stock market dips or crashes, whatever you want to call it. Same thing here in 2001, then again in 2008, and then in 2020, right? In all instances, right before a recession hits, the stock market crashes. It is not the end of the world. In many ways, one could argue that a recession is exactly what we need to sort of reset things because things have gotten out of control. I'm not going to get into that argument because that's a big debate, but let's just say that what I can say unequivocally that nobody will argue on is that it is not the end of the world when the stock market does what it did today, okay? So now that we've covered that, let's talk about stocks and bonds. And this is probably going to be like, oh, I don't want to hear about stocks and bonds, but you need to know this. Why do you need to know this? Because your clients, your prospects are going to, sellers, buyers, doesn't matter. Everybody's going to start putting things on hold. Well, the U.S. economy is going to collapse or there's a recession coming. So now I need to just pause and not do anything until after all of this is over. No, this is exactly the time to do things. As a matter of fact, as far as real estate is concerned, this is going to be a big boost for us. So please, I'm not going to go into too deep of a dive, but I'm going to give you just enough information so that you can talk to your prospects and clients and help them understand why now is still a great time to sell and buy. All right? Okay, so let's talk about the difference between stocks and bonds. And I know this isn't sexy, but I promise if you bear with me, it'll be worth it. So first of all, Over here on the high risk side, we have stocks. And what are stocks? Stocks are small portions of companies, aka shares, that people purchase to invest in the company. Okay. And as the value of the company grows, the shares grow, then people make money called dividends, right? This is basic. You probably know this, but if you don't, then I just want to give you a little bit of an education on this. Bear with me if you already are familiar with this information. Now, stocks are much more high risk, but they also have the potential for a much higher reward. The issue is that if things don't go well, you can lose all of your initial investment. So while there's the potential for great reward, there's also the potential for great risk. Now, on the lower risk side, we have bonds. And what are bonds? Well, bonds are long-term debt that are issued either by companies or governments. And what happens is a person buys a bond, okay, issued by a company or a government, and the person is basically making a loan to that company or that government. And in return, the company or the government pays them for the use of that money. That's called interest. So just like any other loan, the person that buys a bond is making a loan to a company or government. And in return, they receive interest from that company or government. That's how that works. Now, this is a much lower risk associated with this type of investment. However, it also has probably not as, it doesn't carry the same potential for really great reward, but it is much more secure. And unlike stocks, the initial investment, it's almost impossible to lose your initial investment. While it is true that it can be lost, like in the case of a bond issued by a company, if the company goes bankrupt, for example, totally closes out, a government bond, you never can lose your upfront investment because it's backed by the full faith and security of the federal government. So that's why bonds are considered much more safe than stocks, and they also carry a much lower rate of return. So what's next? We have, in particular, in the bonds side, we have mortgage-backed securities. So again, bonds are loans we make to a company or a government. In this case, mortgage-backed securities is a pool of loans, okay, that are all bundled together, aka the company, so to speak. Okay. And then we buy bonds that are securitized, as we say in the industry, and in return, we make interest. And so what happens is as people buy more and more mortgage-backed securities, they are infusing those with more and more money. That's where mortgage money comes from. So the more money that's put into that system, then the lower rates go, because it's the basic law of supply and demand. If you own a corner market and you're selling bananas and you have a whole bunch of bananas and you want to get rid of them quickly, you lower the price. You make it really super cheap because you have too many bananas and not enough people to eat them. On the other hand, if you have only a few bananas, nobody else is selling bananas, but you've got some and people want them, you're going to charge $1 a banana because they're scarce. It's a scarce commodity and people want it, so you can charge more for it. That's why when there's a lot of money being injected into mortgage-backed securities, rates go down. And when there's not, rates go up. And that's what's driving this engine. So if we look at here, this top snippet is mortgage-backed securities, specifically the 30-year 6% note, okay? And here, this bottom snippet is the S&P 500, okay? It doesn't matter. You could have picked the S&P like I did, the Dow Jones, or the NASDAQ. They would all look basically the same. So these snippets go back to about the beginning of July each. And this first orange line is Thursday, August 1st. The second orange line is Friday, August 2nd. And this is what's called a candle chart. And depending on if it's green or orange, so if it's green, that means it started at the bottom and it went up. Okay. In mortgage-backed securities circumstance, that's a good thing. So the higher this goes, okay, in mortgage-backed securities, the better that is, because that means rates are going down. It's an inverse relationship. Mortgage-backed securities go up, interest rates go down. Okay. Now down here in this candle chart, when it's red like this, that means we started here and we ended here. So Thursday, August 1st, was not a good day for the stock market, right? But Friday, August 2nd was a horrible day because Thursday it ended here. And on Friday, it didn't even have a chance to travel. It just started way down here, right? And it just got worse from there. Hence the, aforementioned so-called crash. Not really a crash, but I use the term loosely. What's important here, what I really want you to get out of all of this is not how much the stock market so-called crashed and whatnot. And I'm not trying to make you a mortgage-backed security expert, but what I really want you to see so you can have these conversations with your prospects and clients is that as the stock market supposedly crashed, okay, mortgage-backed securities took off. Why? Because this is the high risk side, right? And this is the low risk side, right? So as this was becoming more and more risky because people saw, oh my gosh, unemployment is just going through the roof. The US economy is, going to go down the toilet. The stock market is not a good place to be. It's too high risk. I need to go into something that's much more safe, less risk. Money was being taken from the stock market and being put into mortgage-backed securities. Okay, people were fleeing to mortgage-backed securities because they're safe, and hence all of that activity pushed rates down, and that's exactly what happened. So as more and more money came funneling into mortgage-backed securities, interest rates were driven down. I think we dropped an eighth or a quarter percent fully on Friday. It was pretty good, and that process is going to continue because as more and more bad news comes out about the economy, people are going to put more and more money into safe investments, government-backed bonds, treasuries, and mortgage-backed securities. So that's what's happening. Please help your clients and prospects understand this, that the world is not ending. Don't believe what you hear on the news because, like I said, going back all the way back to the 1991 recession, we've always recovered and we always will. And somebody once said something to me, and maybe you've heard of this before, money's never lost. It just changes hands. And that's what's going on here. So all will be well. And we just need to help our clients understand. In this particular case, when it comes to real estate, this is actually helps us a lot. So not that I'm wishing bad on the stock market or anything, but it's just a statement of fact. I hope that helps. If you have any questions, please don't hesitate to call me anytime. Otherwise, I hope you have a wonderful day, wonderful weekend, and we'll talk with you soon. Take care.